There we go. Yes. So, Bitcoin. Huge move incoming. When? And in which direction? Well, if you know about trading the VEPs, you know what the probabilities are telling you when it's going to happen. Are we talking today, this week, this month, this quarter, in the autumn? What I can tell you is that's really not how you trade the VEPs. Right? That is not the way to stack and rack. Actually, when we trade velocity, entropy, probabilities, and statistics, you don't actually really care about huge moves. I mean, sure, they're nice. You can offer them nice. They're wonderful when you're in the right direction and you win those trades. But if you actually want to stack and rack and be consistently profitable, trading volatility, entropy, probability, and statistics, the way to do it is to consistently win small trades. By small, I don't mean position size. That's entirely up to your situation, what the size of your bag is. I'm talking about percentage-wise. Okay? You don't need to have outsized moves with huge gains every single trade. And we're back. A little interruption there in the shoot on the live stream. Yeah, so like I said, you don't need to win massive trades to be a consistently profitable trader. You need to win a bunch of relatively small trades, day in and day out. How many trades? That's really up to your trading style. Do you need to get every trade? No, you don't need to get every trade. Not only that, statistically, you can't trade. First of all, you sleep, right? Okay. Kind of hard to trade when you're sleeping. Sure, you can be in swing positions. It's extremely dangerous to do that, or extremely risky to do that, especially when you're trading extremely volatile assets like crypto, or frankly many stocks, or forex, or even commodities. In recent years, we've seen some pretty wild moves relative to those assets and to the positions that people put on, which in commodities and forex, typically, average traders will use some leverage because those assets move so little that they want to have some kind of, decent gains. So they'll use some leverage, but that's extremely dangerous, especially if you're sleeping, because what if it goes the wrong way and you're in a trade that's in an overnight market, or overnight your time, or whatever, you're resting during the time, but the market is open, or you're just away from your desk and you're leaving your trade on and it goes the wrong direction. It's not a good idea. I know people do it and they think it's wonderful until they lose a trade. That helps their position get wrecked. Right? So the idea is not to try to catch the extremely huge moves incoming. Now, that means that what you do is you set your realistic targets according to the standard deviations, the Laplace distributions, and you don't get greedy. You get a position on when the occurrence of opportunity exists, and you get in and you get out as soon as the asset hits your target, right? Or if you're wary, you can get out even a little bit before it hits your target. Could it keep going in the direction beyond your target? Yeah, sure. Especially if you're dealing with extremely volatile assets. But Does that mean that you should stay in the position after it hits your realistic target? No, it doesn't. Right? It means you should get out and take your profit and then reposition for your next trade. Could it be that it continues in that direction? Sure. Can you stay in a position longer after it hits your target? Yes, if the information is telling you this is likely to keep going in your direction and you are likely to see more gains, then sure, why not stay in the trade? But be wary, be cautious, and get out as soon as you see the information telling you, you really got to get out now because it could turn around any second. And again, even if it turns around just for a tiny little bit, right? And then just continues back in that same direction, and you're like, oh, I took my profits too early. No, you didn't take your profits too early. Maybe what you did is you took your profits and you didn't reposition fast enough. But you're still better off taking those profits and having more capital in your base for the next trade. Why? Because as long as you leave those profits unrealized, they're not real. It's not really your money. It's not really your gains. You haven't actually added to your P&L, to the P part of your L, to the P part of your P&L, that is, right? All you've done is, created some nice positions that you're just sitting in, and volatility or entropy could easily just turn around and take it right back from you. If you don't think that's possible, just look at some low time frame trades just in the last 24 hours on Bitcoin, which moved up quite nicely. Yeah, but if you did what a lot of traders did, you got into the long positions too late if you're using lagging information, and you got out of the positions too late with the same lagging information. Whereas if you were trading with the VEPs, you would have seen when to get in and when to take your profits and reposition and when to go back into the move for continuance, right? Or you would have taken your profits after one position, flipped it, taken a very fast scalp to the opposite direction, taken your profit as soon as it hit that reposition target, and then flipped it again, and then re-entered for the continuation. In yesterday's case, it would have been, the continuations were to the upside, and the flips to the downside were the fast scalps, but the faster scalps. Of course, depending on your time frames, if you're trading like 15 minutes or something. But even on like the 9 minute or the 6 minute, where a lot of people are comfortable trading, or even the 3 minute, and that'll happen a lot. On the 1 minute, so many hills and valleys that it doesn't, honestly, the direction of the day kind of doesn't matter. It's good to know. It's generally helpful to know. It's generally helpful to know even the direction of like a 15 minute. But you're not trading anything close to a 15 minute when you're down on the 1 minute. You're trading sense of how things are moving throughout the day. But the 1 minute where your action is, when you're trading that time frame, is a low enough time frame. The hill, one side of the valley, on every single 15 minute candle, you'll see that on the 15 minute, not on 1 minute time frame on Bitcoin or Solana or Litecoin or Ethereum, right, or any of those volatile crypto assets, right? It just doesn't sit in one place for 15 minutes. When it does, it's usually because there's some kind of a problem with the exchange. But the actual asset itself is not sitting flat for 15 minutes, right? Volatile assets don't just sit flat, right? Especially not during times like the bulk majority of people doing the trading. They're not running the majority of trades, doing the trades, and the bulk majority of those people, like way more than 99%, don't have a clue about VEPs. They trade lagging indicator, traditional technical analysis. They are all at a disadvantage to you if you trade the VEPs. Right, now, why do I say they're at a disadvantage to you? Well, because, again, they're using lagging information. They can't possibly have a technical advantage over your information because the information they're looking at is all about. They have zero probability information in terms of real useful probabilities. Sure, they can calculate probabilities of the price, but they have nothing to do with reality of where probabilities of the actual returns are going to go next, and therefore they can't say where the price is going to go next. You know, it's like without even getting into a metaphor, when you're calculating the probabilities based on price, you're calculating the wrong probabilities. Okay? When you're calculating the statistics based on price, you're calculating the wrong probabilities. When you calculate the wrong statistics, when you calculate the probabilities or the statistics based on the returns, well, then you have relevant probabilities and statistics to determine what the price is going to do next. Why? Because price action follows the returns. Right? Price action doesn't follow price action. Price action is just price action. It does what it does, and in a random market, most of the time it's random. How do you know when it's not random? You look at something like our entropy indicator, which tells you specifically when it's random or in a trending move. Can you trade it when it's a random walk? Yeah, of course you can. But you should know that it's in a random walk, and you should know what that means, right? And that's why you have to look at the volatility as well as the entropy in order to know, is the probability of price likely to go up or down or sideways? And the volatility and correlation will tell you that exactly, just as the entropy and its correlation will tell you that. So don't get stuck in a loop thinking that, you know, you can use lagging traditional technical analysis in order to determine the future price action, because you can't. Okay, that's not how you determine future price action. If it was, then that is what all the high frequency trading firms would be doing, and all the quant shops that run their own algorithms and also provide services like that for clients, they'd be doing that too, but they don't. They calculate the probabilities of the future price, which is really calculating the probabilities of the future returns, which leads to the price action that follows, right? They calculate it based on the returns, not price action. Because if you try to calculate it on price action again, you're just calculating past information that has no bearing on the future. Now, why is that? Well, first of all, math, okay? If you've ever taken a statistics course, if you've ever learned about probabilities and statistics in school or college, then fantastic. First of all, if you have learned that in school, amazing, you probably went to a great school, or you probably had a great teacher at some point that taught you that. Most schools don't even include that curriculum. In fact, no school includes that as a default curriculum. That's the kind of thing that if you're lucky, you'll learn in college, in America anyway. But second of all, if you know anything about probabilities and statistics, right, you'll know when you're looking at numbers like price action versus returns, okay, you'll know that the price action is made up of what's happened on the charts in terms of the buy, you know, the buy and sell pressure and the difference between them, which leads to the resulting price action. How does it do that? It's following the returns. It's really quite simple. So don't get stuck chasing price action, because as I said a million times, price action is moot. The leading information, meaning the forward-looking information, the current information that looks forward and gives you the best probability of projecting and predicting and correctly estimating the tendency of what the price action will be, is based on the mean of returns, the returns on investment themselves, right? And using tools like volatility and entropy to actually determine what is that tendency of the price action, right? You can learn those things for free in the Alpha Trading Discord. I know I say it practically in every video at this point. Go to alphatradinghq.com and click on the Discord link, or just go directly to alphatradinghq.com/Discord, and that will take you directly into the Alpha Trading Discord. And there, go into the request support channel and just request free access to our free volatility starter pack of indicators. We even give you a free chart that's pre-populated with the indicators that you can use, and we have tons of educational information, and you can access the live chats and access the the chat channels and access the live streams. You can participate in the live streams. It's not just like we broadcast and tell you how things we're not a signals channel, right? It's an educational experience. We're providing you with free education. We're not trying to shill you our indicator. We didn't care if you never buy our indicators. We seriously do not care. If we cared about that, we would have focused on that since the beginning. We don't focus on that. We're a tiny community. The reason we're a tiny community is because we don't focus on just shilling our stuff to millions of people and then hoping they buy, or pushing them to buy something that they're never going to learn, they're not going to use right, and then they're just going to disappear. Okay? Because our tools are not like just push here dummy tools. You actually have to learn how to use them as if you're a professional trader. And if you don't, well, then you're going to not have the best experience possible. So go and do that. Come and learn. It's all for free. And see you there. Happy trading.